أعوذ بالله من الشيطان الرجيم بسم الله الرحمن الرحيم رب اشرح لي صدري ويسر لي أمري واحلل عقدة من لساني يفقه قولي. In our lesson today, we shall be talking about risk management in Islamic investments. This is one of the most important lessons, more so in Islamic finance. As usual, we shall start with the lesson objectives. So these are the lesson's objective. By the end of the lesson, the learner should be able to, number one, define risk management and explain its purpose in identifying, assessing, and mitigating potential financial risk. Number two, describe the role of risk management in ensuring sound financial decisions. Three, highlight the emphasis on ethical investing and risk sharing in Islamic finance. Number four, identify and explain the key risks in Islamic investment. Number five, discuss risk management tools in Islamic investment. Then lastly, analyze the challenges and explore opportunities for growth in Islamic investment. So this shall be our lessons objectives. So number one, it's very important to define what is risk management. Like what comes into your mind when you hear the word risk management. So risk management is the process of doing what? Number one, identifying, assessing, and mitigating risk. Why are we doing all this? That could adversely affect an organization's financial objectives. So when you're talking about risk management, it is basically the process of trying to identify, trying to evaluate, and trying to prevent risk that could adversely affect our financial position, that could adversely affect our bottom line, which are the profits of the company. It involves evaluating potential threats, implementing controls to minimize risk, and planning responses to unexpected events. Okay, now what are the importance? What are the importance of financial? What are the importance of risk management in financial decision making? So number one is capital preservation. Number two, profitability. Number three, stakeholder confidence. Then number four, regulatory compliance. So let us start with the first one, which is capital preservation. So when you're talking about capital preservation and its importance, we are basically saying that capital preservation is a fundamental principle of investing, emphasizing the need to protect the original investment from losses. Remember, as an investor, you normally put your capital in an investment, and what you require is that this capital grows, you gain some profit, you gain some revenue, you gain some returns. So effective risk management strategies focus on identifying potential risk and implementing measures to hedge against them, thereby safeguarding the principal amount invested. For example, consider an investor in an equity fund. If the market experiences volatility, that is, unexpected political events or economic downturns, the value of the stock may plummet. A well-structured risk management strategy, such as diversifying investment across different sectors or using options to hedge against potential losses, can minimize the impact of such volatility. For instance, if the investor allocates some funds to bonds, which typically have lower risk, while also investing in stocks, the bond investment can help buffer potential losses in stocks, preserving the overall capital. So basically what they're trying to tell us here is the idea, one of the ideas or one of the principles of business is that when you are investing, don't put all your eggs in one basket. So in business, you are required to do what? To diversify. That is, invest in different portfolios, invest in different businesses. By doing that, you will be avoiding the risk. Like when you invest in one, let us say you are investing in only restaurant. So if anything happens, you go back to square one. Number two, another importance of risk management in business is what is known as profitability. Effective risk management not only protects against losses, but also enhances profitability by allowing for informed decision making and risk taking. These two things are very important: informed decision making and risk taking. Informed decision making means that we evaluate the environment in which we are working on, and then the data, the information we get from the environment, we use it to make decisions. And also, when you're talking about risk taking, because as a business, you'll always have to take a risk, but you are advised when you are investing to take a calculated risk. So by understanding potential risks, businesses and investors can pursue opportunities that are more likely to lead to favorable outcomes without excessive exposure to loss. So here, basically, they are advising us. They are giving us a principle of investing that is, yes, it is okay. Business is all about risk, but then we need to evaluate the risk. We need to evaluate the risk to take calculated, reasonable risk. For example, a technology startup looking to invest in a new project may conduct a thorough risk assessment, analyzing various factors such as market demand, competitive landscape, and financial projections. By identifying potential pitfalls, the startup can allocate resources more effectively. For instance, by choosing to develop a product with a clear market need verified through market research, rather than a risky, innovative idea with no customer validation. The startup increases its chances of profitability while managing risk associated with product development. Number three is stakeholder confidence. Transparent and effective risk management practices do what? What's the importance of this? It inspires. It is inspire confidence among stakeholders, including investors, clients, and regulators. Confidence in a company's ability to manage risk effectively can lead to what? Can lead to increased investment, deep stakeholder relationships, and positive reputational impacts in the marketplace. So this is one of the advantages of risk management. If you have a reputation of managing risk efficiently and effectively, then the net effect is that the stakeholders, they're going to have confidence with you, and they're going to inject more money in your business. So for example, a large financial institution facing regulatory scrutiny due to past compliance issues can enhance stakeholder confidence by developing a robust risk management framework. By establishing clear policies for risk assessment, compliance training for employees, and regular audits by external parties, the institution demonstrates its commitment to responsible practices. This proactive approach can restore investor trust, potentially driving up stock prices and attracting new clients. And all these factors, at the end of the day, is going to help us to grow and gain more profit. Then lastly is what is known as regulatory compliance. What is the importance of this? In many industries, particularly finance, businesses must adhere to regulatory frameworks designed to protect stakeholders and ensure market integrity. Effective risk management systems help organizations comply with legal standards, reducing the likelihood of costly penalties and damage to reputation. For example, a bank that provides consumer loans must adhere to regulation such as the Dodd-Frank Act in the United States. This is an example in the United States. Many banks, they have to, when they're giving or when they're providing consumer loans in America, they need to adhere to. I need you during your free time to go and research more about this act. So through effective risk management practices, the bank can assess the creditworthiness of borrowers, ensure fair lending practices, and monitor compliance with regulations. By implementing a robust risk management framework, such as using risk-adjusted pricing models and conducting regular compliance audits, the bank mitigates the risk of regulatory violations. In the event of compliance checks, a well-documented risk management approach can help demonstrate adherence, preventing fines and maintaining a positive reputation within the industry. So these are the four importance of what? These are the four importance of risk management, in what? Importance of risk management in financial decision making. Now, we've finished with the importance of risk management in decision making. Now, the next thing we want to do is to do what? So we've already covered the importance of risk management. Now, the next thing is about the unique aspect of Islamic investment. So what are the unique aspects of Islamic investment? Like, what distinguishes Islamic investment as compared to the conventional investment? So there is number one, what is known as the principle of Sharia compliance. Islamic investments are governed by principles derived from Sharia, Islamic law, which dictate permissible financial activities. The key prohibition include, number one, so these are the principles that normally guide Islamic investment. Number one, the prohibition of riba, which is interest. So Islamic finance prohibits earning or paying interest, as it is considered unjust and exploitative. Profit must come from legitimate trade or asset-backed transaction like their sukuk, rather than passive interest-based income. Number two, prohibition of gharar, which means excessive uncertainty. Contracts, when you're signing a contract with an investor, when two companies are signing a contract, it needs to be clear, transparent, and free from excessive uncertainty or ambiguity. Ambiguity meaning that something that is not clear. So contracts should be very clear. Speculative activities such as gambling or high-risk derivatives are not allowed in Islamic investment. Number three, prohibition of haram activities. In Islam, there are activities that are completely prohibited in the Quran and the Hadith, which are the sources of Islamic Sharia. So investments must avoid industry or businesses involved in haram. Haram means forbidden. So forbidden activities such as alcohol, gambling, pork, and other unethical practices. So they are not allowed. So this is one of the unique aspects of Islamic investment. Number two, another unique aspect of Islamic investments is the emphasis on ethical investing. So Islamic finance promotes social justice, fairness, and the well-being of society. So investments are made within an ethical perspective, ensuring that wealth is distributed equitably and benefits the broader community. That is why in what? In Surah Al-Hashr, in the Holy Quran, it is clearly stated, Allah clearly states in the Holy Quran, لِكَيْ لَا تَكُونَ دُولَةً بَيْنَ الْأَغْنِيَاءِ مِنْكُمْ. That is, wealth in Islam needs to circulate. That is why in Islam we have what is known as zakah. So the main idea behind the zakah is that the wealth or the rich, they give the poor something. And by doing that, money will be circulating in the economy. So when you're talking about emphasis on ethical investing, there are three things that are involved here. Number one, asset-backed financing. Investment must involve tangible assets, ensuring a connection to the real economy. So here, this is, for example, the sukuk. So when you are investing Islamically, when you're investing in something, you should be investing in something that has value. You cannot invest in something that has no value. Then also avoid speculative practices that create financial instability. Number two, social responsibility, masuliyatul ijtimaiya. So encourages investment that positively impacts society. So Islam encourages us to invest in what? In industries, sectors that positively impact the society, such as funding projects for affordable housing, clean energy, and education. It can also be in the hospital industry. Number three, charitable contributions, zakat. So a portion of wealth in Islam is directed toward charitable purposes, promoting financial inclusion and alleviating poverty. So by giving zakat to those people who are poor, number one, you are going to alleviate poverty. Number two, when you give them the zakah, then they are going to invest. And when they invest, they're going to get something and when they get something, they're going to empower themselves. So they'll not have the time to beg and beg and beg. Okay. Key risk in Islamic investment. So when you are investing as a Muslim, there are some risks that you are likely to encounter. One of the risks, there are very many. So the first one is the Sharia non-compliance risk. So what is the definition of this Sharia non-compliance risk? The risk that an investment or financial products fails to adhere to Sharia principle, leading to legal, financial, or reputational repercussions. So sometimes, especially most of us, we live in countries that are not Islamic countries. So sometimes we might invest in businesses that don't comply to Islamic Sharia. So what can be the consequences of this? Number one, reputational damage. Losing trust among clients and investors due to perceived ethical breaches. So people are not going to invest in your company. People are not going to invest with you because you are involved in a business, or you are investing in what? In investment that don't comply to Islamic Sharia. Number two, legal penalties. There is what is known as regulatory fines or sanctions for non-compliance. In some countries, like Malaysia, like Qatar, like Bahrain, if they find you not complying to Islamic standard and Sharia, then they are going to fine you. Then number three, financial loss. Profits from non-compliant activities may need to be purified by donating them to charity. And when we do that, it is going to do what? To reduce our return. So this is the first risk. Number two, there is the market risk. And what is the market risk? The risk of losses due to fluctuation in asset prices, interest rates, or economic conditions. So of course, we are doing business. And while we are doing business, we need to live to the fact that the environment keeps changing every day. Today you wake up, the interest rates are high, or maybe they're low, or the economic condition is not good. Sometimes it is good. The asset prices sometimes keep fluctuating. So all these factors, lead to what is known as the market risk. So what is the impact of this market risk on our investment? So number one, asset-backed nature of Islamic finance exposes investment to price changes in real estate, commodities, and other tangible assets. Because investment in Islam are attached or associated with assets. So if there is any change in the price of the asset, then automatically it's going to affect the investment. Number two, Profit sharing models like Mudaraba and Musharaka are directly affected by market performance. You know, if the market is doing good, your investment in Mudaraba and Musharaka will be okay. But the opposite is true. And for example, a sukuk, a bond, Islamic bond linked to a real estate project may lose value during a property market downturn, reducing returns for investors. Credit risk, this is another type of risk. What is credit risk? The risk that a counterparty fails to meet its financial obligation. You know? So when you're talking of credit risk, and this normally happens many of the times in the bank. So for example, if the bank gives you a loan and you fail to pay the loan, that is known as a credit risk. Or sometimes if you're doing business, you give goods on credit and somebody does not pay you on the agreed debt. So that can be very detrimental to your business. So what is the impact of this credit risk on Islamic products specifically? Number one, you have the murabaha. So risk arises if the buyer defaults on installment payment. Remember, when you're talking about murabaha, as in it's an agreement between you and the bank. So the bank, you identify an asset or you identify something you want to buy. So the bank is going to buy it on your behalf, and you're going to sign a contract that every month you'll be paying something to the bank. But sometimes you might default, you might not pay the bank. So who will be in the loss? The bank, of course. Ijara. If a lessee fails to pay rent for leased asset, the financier bears the loss. For example, you're having a house, you know, and you rent it to a tenant, and the tenant fails to pay you at the end of the month. So who's going to get the loss? The landlord, of course. To cook, default by the issuing entity can result in loss of principals and income. Default, for example, if there is a sukuk by the government, it has issued a sukuk and people have invested in that sukuk. Sometimes the government can fail to pay you back your money, the money you invested in the sukuk. Number four, we have the liquidity risk. So the risk, what is the liquidity risk? This is the risk of being unable to convert, and the risk of being unable to quickly convert assets into cash without significant loss in value. So remember, in business, we normally need money. As Suyula, we need money so that our business can run. But sometimes you can find yourself in a situation where it's difficult to convert assets into money. For example, you're having a business, you're selling some goods, and you want cash. Sometimes, of course, you'll be forced to sell the products in your shop. And sometimes, maybe if you don't have customers, what is going to happen? You're not going to have the cash flow. So the challenges in Islamic finance, so a limited secondary market for Islamic financial instruments, making it harder to sell or trade assets because the Islamic finance is still developing. So we don't have enough secondary markets, unlike the conventional markets. Number two, the long-term nature of many Islamic products like sukuk and real estate investment. So like sukuk and real estate investment, before you'll only get your money after a long period of time. So you cannot get money in the short run. For example, an investor holding a sukuk may struggle to sell it in the secondary market due to low demand, especially during economic downturn. Then we also have the operational risk, the risk of loss resulting from inadequate internal processes, human errors, system failures, or external events. So sometimes there are factors that can affect your operations. For example, it might be related to your processes inside the organization. Sometimes it might be related to the human resource, human error. Maybe they are incompetent, and because of their incompetence, they do a lot of things that might affect your investment or your operation. System failures إلى غير ذلك. So what is the impact on investment? The impact of this operational? So complexity in Sharia compliance requires specialized expertise and robust governance, because Islamic Sharia is very complex in its nature. It requires people who have specialized in Islamic Sharia, fiqh, hadith, and it also need a governance. And when you're talking about a governance, it's all about hawkama, in Arabic they say that, or it's all about putting systems in your organization that is going to help in matters related to decision making, in matters related to accountability, and in matters related to performance. Errors in structuring or documentation can lead to non-compliance or financial losses. Sometimes there can be errors when you're structuring, for example, a contract, and this contract or agreement can sometimes lead to miscalculations, can sometimes lead to significant errors that might impact our investments or even the reputation of the organization. So these are the five types of risk that can affect us when you are investing in Islamically. Okay, what are the tools and techniques for risk management in Islamic investment? So what are the tools that can help us to minimize risk? Because remember, we want to minimize this risk in our organization, in our investment. So number one, there is what is known as Sharia audits and governance. So when you're talking about Sharia audits and governance, we are talking about a comprehensive system to ensure that financial products and operations align with Sharia principles. And this is where we normally have the Sharia boards. In all the Islamic organizations, financial institutions, you'll always find Majlis al-Shariah, or the role of Sharia board. So what is their role? Number one, they normally provide guidance on structuring Sharia compliance products. Like how should the product look like, the contract. Number two, conduct regular audits to ensure ongoing compliance. The Sharia board, it regularly does what? Audit the organization to ensure they are complying with the Sharia standards. Number three, offer resolution in case of ambiguity or dispute over compliance. In cases where in cases where there are disputes or where things are not clear, ambiguity means things are not clear, then it is the role of this board to clarify these issues, and where there are disputes, it is also their role to mediate. Then number two, we can also reduce or minimize the risk by doing what? There is what is known as diversification. So what is diversification? Diversification means not putting all the eggs in one basket. Like if you are an investor, you should invest in different sectors, such that if something happens in sector A, you still have sector B, C, D unaffected. But if you invest in just one sector, and if something happens, you can imagine you're going back to square one. So diversification means what? Spreading investment across various asset classes. So you can invest in different assets, or you can invest in different industries. Maybe you can invest in education industry, you can invest in the service industry, the telecommunication industry, and also geographical region. You can also decide that I'm not only going to invest in Somalia. I can have some investment in Kenya, Djibouti, Ethiopia, or even if it is in one country, you have investment in different regions. So what are the benefits of diversification? Number one, mitigates market-specific risk. For example, downturn in real estate or oil market. Number two, balances portfolio performance across volatile sectors. Then lastly, protects against losses from regional or industry-specific economic shocks. Another way we can minimize risk is takaful. And when you're talking about takaful, we are basically talking about what? Islamic insurance. So a Sharia compliant insurance mechanism where participants pool funds to mutually cover losses. So takaful basically means we might be having a group of people coming together and they decide to pool some resources together, and they normally do what? So they normally pool resources together and they have an agreement. If, for example, I am faced with any difficulty, then the others are going to help me. So that is the idea of insurance, and that is how the insurance company, they normally work. So you pay some premiums, okay, monthly maybe, and in exchange of the premium, the insurance company is going to do what? To insure your business, to insure your car, ila ghairi dhalik. So how does it help our investment? Number one, provides financial protection against unforeseen events. Because sometimes you don't know what is going to happen, fire, accident. So the insurance company will help us in those cases. Number two, reduces operational and credit risk by covering losses related to defaults or asset damage. Then lastly, encourages mutual cooperation and shared responsibility. And this is what is known in Islam as what? التعاون وتعاونوا على البر والتقوى ولا تعاونوا على الإثم والعدوان. Now, what are the challenges and opportunities in Islamic investments? Like what are the, so number one, what are the challenges that are facing us as Muslims when it comes to investing? Number one, there is what is known as limited standardization in Sharia compliance. So different interpretation of Sharia principle by scholars and regulatory bodies in various regions lead to inconsistency in financial product structure and operation. So we don't have standardization. If you go to Bahrain, they have their rules regulation. If you go to Malaysia, if you go to Saudi Arabia, then you also have the ulama, the scholars, the way they interpret, the Sharia principles. In Malaysia, they can interpret differently. So all this complexity in interpretation can really have a negative effect. It can really affect us. So what's the impact of all this? Number one, the impact of not having a standard or standardization in Sharia compliance is that it hinders cross-border transaction and global adoption. So we cannot transact between countries because there is no uniformity in the rules. Then increases operational complexity and cost for financial institutions. So there are also a lot of costs involved with not having a uniform set of rules. Then another challenge here is doing what? Balancing ethical principles with financial performance. So another challenge is balancing. So ensuring Sharia compliance often requires additional due diligence, limiting access to high yield but non-compliant opportunities. So sometimes, yes, there is an opportunity to invest, but it is in a haram thing. So you cannot invest in something that is haram. Yes, it's a good opportunity. ولكن في المقابل, it's haram. So the impact of this, challenges in achieving competitive returns while maintaining ethical integrity. So you cannot get enough return. But that is according to them. But for us, Islamically, we believe that if we invest in anything that is halal, man taraka shay'an lillah awadahu khair. If you leave things that are haram, then Allah is going to compensate you with something that is better. Now, what are the opportunities in Islamic investment, Islamic finance? Growth of Islamic finance globally. So the Islamic finance sector has seen significant growth due to increasing demand for ethical and Sharia compliance investment. The Islamic finance is growing, and it is growing at a very fast, it's growing at a high rate. It's growing very quickly, you know? Then, so what's the impact of this growing? Expanding market in Muslim majority and non-Muslim. So most of Islamic, Muslim and non-Islamic countries, they've adopted what? Islamic finance. New investment opportunities in sectors like infrastructure, healthcare, and green energy. So all these are opportunities. Number two, technological advancement in risk management. So emerging technologies like fintech, blockchain, and AI are revolutionizing risk management in Islamic finance by enhancing transparency, efficiency, and compliance. So the technology actually is a game changer. Many Islamic institutions, they have really embraced, they've been receptive towards to the technology. So that's the end of our lesson. If there is any question, you can ask. If there is any question, please, you can ask. So Asia, you are attending when the lesson is finishing. Where have you been? Huh? You're just coming when the lesson is finishing. So where have you been?
Okay, teacher.
Nam.
Thank you.
Okay, inshallah. So we'll meet tomorrow, and next week you'll be having a quiz. Tomorrow will be our last lesson. So tomorrow I'll be giving you the instruction about the quiz. So next week you'll be having a quiz, and the quiz will be carrying 20 marks. It will be out of 20, it will be the 20% of your assignment. So tomorrow I'll give you the details about the quiz, inshallah.
The next quiz is 20% in my...
Yeah, it will be next week. So I'll give you a quiz next week, inshallah.
Inshallah.
Okay. Okay, Massalam.
Wa alaikum salam.